Following a couple of videos exploring the topics of taxation, here in the UK at least, and the richest people in each of the world's 7 continents, today I thought we'd get back to basics, with a video covering some of the most fundamental tools of wealth building in the 21st century, what they are, why they're so popular, and why it matters to understand them. So, if you're someone who has never invested before, or has only ever invested passively through a pension, or even if you're someone who has never even heard of the terms S&P 500, FTSE 100, or the DAX before, then fear not, all will soon become clear, and it's all really very simple. There are lots of different ways in which people describe their investing. Some people describe themselves as value investors, growth investors, venture capitalists, the list goes on. But perhaps the defining differential between individual investors in 2021 is whether they invest passively or actively. Passive investors do not buy or sell individual stocks. They tend not to react to fluctuations in the stock market or the wider economy, and they look to hold on to their investments and add to them gradually over time. Active investors are more likely to invest in individual stocks, they might make more frequent trades, and they're less likely to hold on to investments for the rest of their lives. The S&P 500, the FTSE 100, mutual funds, and ETFs are all forms of passive investment, and instead of buying individual stocks, you are buying a basket of stocks, typically in a specific region, a specific industry, or with a specific market capitalization. So, to give you an example, the S&P 500 is an index made up of the 500 largest companies in the United States. There are actually 505 stocks in the S&P 500, but that's just because some companies like Google and Fox have multiple common stocks listed on the index. When you invest in the S&P 500, whether that be through Fidelity, Vanguard, or anyone else's S&P 500 indices, you are buying into the 500 largest companies in America by market capitalization, which account for around 80% of the entire equity market in the United States. If that isn't enough for you, there are other indices like the Russell 1000, 2000, and 3000, or the Vanguard Total Stock Market ETF, or the Dow Jones US Total Stock Market Index, which contains almost 4,000 stocks, accounting for around 95% of the total US stock market. Because the biggest companies in America are so dominant, the performance of an S&P 500 index versus a total market index is likely to be very similar. But sometimes the indices which contain smaller market cap companies will be a little bit more volatile. The FTSE 100 is just like the UK equivalent of the S&P 500, except it is just made up of the 100 largest companies in the United Kingdom. In Germany, you have the DAX. In France, there is the CAC. In Australia, it is the ASX. I could go on and on. In countries like the United Kingdom and the United States, indices I should say, like the S&P 500 and the FTSE 100 aren't actually as geographically concentrated as you might think, since most of these companies are so global. Therefore, they tend to be dictated more by sector than region. So, the S&P 500 is very tech-heavy. Meanwhile, the FTSE 100 is geared more towards the financial sector and consumer staples. It's worth noting that when you buy a specific ETF, say the S&P 500, you are not buying a fixed set of companies or stocks. Businesses, albeit not that frequently, drop in and out of the S&P 500, the FTSE 100, and the other indices as their market capitalizations grow or shrink. Therefore, when a business performs poorly, you cease to own it, and when a business performs well, you will automatically be invested in it. You can begin to see how this style of investing is considered to be passive, because all you are doing is putting your money in an index, and then the work is done for you. Because index investing is so simple, and a lot of people don't like the increased risk and effort associated with investing in individual stocks, it has become incredibly popular. Vanguard, which was founded in 1975, are often considered to have been the pioneers of low-cost, passive index fund investing. Their founder, Jack Bogle, having been one of the foremost exponents of the practice. But It's really over the last 10 to 20 years that index investing has really exploded. In 2008, ETFs, which just stands for Exchange Traded Funds and typically refers to any non-actively managed index fund, accounted for 25% of all assets held in the United States. Within a decade, that figure had risen to 45%. Soon, it will be more than half, and there's good reason to believe that this is a trend without any signs of slowing down. But why are ETFs so popular? Since, in many respects, investing in an ETF seems to be counterintuitive. Whilst the appeal of passively investing into an index fund is obvious to someone who wants to grow their money without devoting too much time or effort to that pursuit, for people who are willing to put in more time and effort to try and outperform the market and the major indices, ETFs can seem incredibly inefficient. Lots of people look at the concept of buying the 500 largest companies in the United States right now and think, well, I could just pick the ones that I think will do well. If I can pick out the best performing 5, 10, 15 or 20 stocks on the index over the next 10 years, I will massively outperform the market and the index. Even if I were to buy, say, 450 stocks and just avoid some of the worst performing ones, that would still represent considerable outperformance of the index. And they are quite right. The problem with that way of thinking is that that is quite a big if. People who become engaged with investing can have a tendency to think that they are better at picking stocks than they actually are. History shows us that individuals very rarely outperform the market. That's not to say that it is impossible, just that, as a rule, 99% of people would be better off investing in an index, or a couple of indices, than they would be trying to pick out the winners and losers from the S&P 500, the FTSE 100, or any other ETF. There's also the issue of convenience and cost. If your broker charges a fee every time you buy or even sell a stock, buying 450 stocks is unlikely to be economically viable, even if you can pick out the winners and losers with a decent degree of accuracy, unless, of course, you are investing a seriously large amount of money. Similarly, ETFs tend to have very low fees. There are Vanguard and iShares ETFs, for example, which charge as little as 0.03% as an expense ratio, which is essentially negligible. That's all well and good, you might think. Perhaps I won't be able to pick out the winners and losers whilst holding down a full-time job, studying at uni, raising a family, or all of the above, but what about an investment professional? Well, that's what mutual funds are for. A mutual fund is much like an ETF in the sense that you pool all of your money together with lots of other people, allowing you to invest a very small or a very large amount in a number of different stocks, assets, and securities, rather than in individual businesses. However, whilst an ETF is automated, absent of human involvement, and based purely on mathematics, a mutual fund is managed by a fund manager or multiple fund managers, often with researchers and analysts working underneath them, who research and evaluate stocks based on their own judgment. Like ETFs, there are mutual funds for just about everything, whether that be focused on certain regions, sectors, different sized companies, those at differing stages in their growth or development, etc., etc. And then you get mutual funds which don't necessarily have any specific modus operandi, but you are just placing your trust in the fund managers to make good decisions with your money. Again, you might think that mutual funds are clearly preferable to ETFs, because lots of very clever, well-paid people working in big skyscrapers and wearing suits are calling the shots, but that isn't always the case. In fact, the success rate of mutual fund managers when it comes to outperforming the indices is about the same as retail investors, by which I mean it isn't very good. Again though, that isn't to say that there aren't mutual funds which outperform the market, just that they can be few and far between. It's also worth taking a look at how long of a track record a mutual fund actually has. A fund set up in 2017 might have outperformed the market because they have a lot of tech stocks, a big position in Tesla, and they hold some cryptocurrencies. They have all been very lucratively rewarded investments over the last few years, but that doesn't necessarily mean that they will be over the next 3 years, 10 years, or 40 years, which is the type of time horizon that lots of passive investors probably ought to be looking at. What's more, in a lot of cases, you will find that some mutual funds are basically identical to ETFs. Emerging markets ETFs and mutual funds are a great example of this. As the name suggests, emerging market funds are supposed to invest in countries with emerging markets. I actually think this is a little bit misleading since they tend to include large weightings in countries like South Korea, which is a fairly developed market in global terms, but that is beside the point. If you take, say, Vanguard's Emerging Market Stock Index, which is an ETF, and JP Morgan's Emerging Markets Investment Trust, which is a mutual fund, you will find that there is very little difference between those two portfolios. Vanguard's ETF is 37.8% weighted in China. JP Morgan's mutual fund is 37.6% weighted in China. The largest sector allocation in Vanguard's ETF is information technology at 20.9%. The largest in JP Morgan's mutual fund is also information technology at 23.9%. The biggest individual holding within Vanguard's ETF is Taiwan Semiconductor at 6.2%. Meanwhile, the biggest individual holding within JP Morgan's mutual fund is, you guessed it, also Taiwan Semiconductor, albeit with a larger weighting, at 9.4%. But you can see that there is little difference between the two. In fact, of the top 10 holdings in both at the time of this recording, 9 are exactly identical. Furthermore, whilst Vanguard charges a 0.23% ongoing charge for their emerging markets ETF, JP Morgan charges a 1% ongoing charge for the use of their actively managed emerging markets mutual fund. Well, it's 1% on any investments from £0 to £500 million. Any investments held above the value of £500 million, well, they are charged at just 0.7%. But if you've got over £500 million to be investing in an emerging markets mutual fund, I'm not quite sure what you're doing listening to me, when you could obviously be buying Hull City from the Alams and putting me and many thousands of other Tigers fans from across the globe out of our misery. Before I leave you, it is worth pointing out that it is not necessarily an either-or when it comes to passive versus active investing. I personally invest in ETFs, mutual funds, and in individual stocks. It is quite possible that in 50 years' time, and I am rather hopefully assuming that I will still be alive in 50 years' time, it will turn out that I would have been better off investing solely in low-cost, passive index funds. But there are certain circumstances where I think I can identify a trend in an industry or sector, or a company that I can understand that is undervalued, and could provide better returns than investing in the market more broadly. In the future, I may well make a video talking about some of the ETFs or mutual funds that I like, though obviously that does not constitute a recommendation or advice of any kind that you should follow, and nor do any of my other videos, including today's. This video is just to run through the absolute basics of how index funds and mutual funds work, why they've grown in popularity, and why so few people are able to outperform them. Hopefully you enjoyed it, perhaps you learnt something, and if nothing else then, at the very least, at least you now know that £500 million is the threshold for getting down from 1% to 0.7% as an ongoing fee for JP Morgan's Emerging Market Investment Trust. So, get scrimping, every penny counts. Thank you all as ever for watching. Hit the like button, please hit the like button if you enjoyed today's video, apparently it helps with the algorithm. Let me know your thoughts down below in the comments, and make sure that you are subscribed and have notifications turned on for The Reluctant Investor.